Good afternoon, everybody. This is Chrisi from Solstice ATR and Vulcan Capital Research. I hope everybody's doing great on this lovely 4th of July and look forward to seeing you in our chat room. Happy 4th of July again. And what I'd like to do is basically go over some of the illustrations on different instruments and for educational use only. And that way you can get a better idea what the outlook is going to be for the next 2 quarters from July till end of the year in December. We have recovered quite a bit from February, that major drop that we had till March, then we till June of this year, and we're starting July 4th and the holidays. We have recovered quite a bit of this over the 61.8 fib on the daily chart. On the weekly chart, you can see that. And from here, you can see that the four instruments is the SPX, the NASDAQ, the Russell, and the Dow Jones Industrial Average. As long as we're above that 40,200 area, I'm going to be considering myself bullish. We are holding on the weekly chart, the 50 simple moving average. Unless I lose that, then I'll look for the 38.2 fib, then the 18 SMA, and the 116. Let's first start. I usually do it other way around. Today I'm going to look at the S&P 500 ES. And on the weekly, you can see that last week that major move back up. We recovered. Let's go look at it on a daily basis. And what I'd like to do here on the daily basis is just go over the area here from the February move down from this area here. The February 20th, 23rd area when we fell through that gap down, which we haven't recovered. We fell all the way from the H pattern 1853. This is a very major area of the volatility, and the chop continues in the next quarter. Keep an eye on this area. Is it possible we can come back to the, to the 2850 area, 2825? Of course we can. But most importantly, as understand trade what you see, not what you think. We are still in a major uptrend. We have this another channel up here. We are holding the 50 SMA, and on the daily we are holding the 18 SMA. We broke through the channel, but we still have a linear regressional channel, which created like a W pattern. We have a poor high here. If I zoom in here, what I want everybody to understand is this. We had that 56 in the overnight and a quarter look here, and on Friday we looked at the 56.50 and rejected that area. And we had, not Friday, I should say Thursday, because Friday was a holiday because of the 4th of July. We had looked inside the range of the Thursday price action on the charts. So let's look at it as an overall market and what we can do, what we cannot do to understand the technical. Are we in a symmetrical triangle? Yes. If we lose this area and we cannot hold the 25 and the 08 area, look for the 92, then eventually the 3039, the 3019, 308, then eventually the 92 back to the 2900, and the 2853 and 2823 would be down here. If we're going to continue higher before I do the fibs, and we clear this symmetrical triangle, we clear this top, this major gap here, we can continue higher to the annual high and continue all the way to about the 32.48. So let's take a look at it on a faster time frame, and I'm going to change it to monkey bars. This is on a 4-hour range. A little bit on so you can see what I'm looking at. Come on. And if you notice this prior drop from here, I did a channel on it. We retested these 4 areas. The gray areas are the overnight. The daily sessions are the black area. We created that rounded bottom. This was the Friday session because of the holiday. We're not trading in the US. You can see that they looked inside the range but fell down and came back up into it to close right at the bottom of Thursday's action. Let's go to style in this setting. Go to the monkey bars, and inside the monkey bars, this is what's showing you a 15-minute 5-day. Okay, we're going to go style. I'm sorry, the setting, the time frame. We're going to go 10 days outlook. We're going to, instead of 15-minute, we're going to go to a 30-minute bar. Push OK. I'm going to zoom down. If you notice, this is the Monday session, Tuesday, Wednesday, Thursday session. This was the Friday short time. If I take a look at the low here, that was 29.8350, and the high here was 56.50. So what we're going to do is grab a Fibonacci. And what are we going to do? Grab that 83.50. There we go. To the top, which is 56.50. Close enough. Edit it. Properties. And what you do here is put 50. We edit the other one to 50. And push OK. We notice that the 50% line is 37. As long as I'm above the 31.15 on Monday when we come back, going back to the 25.35 and continue to clean this up, as if this is considered a clean top, and we cannot hold above this Thursday, Friday price action, and we fall back below the 30.90, the 30.83, which was down here, then we go to the 80 area, 45, and eventually fall back in this range of the prior week consolidation. So trade what you see, not what you think. Don't be biased to one side, because the volatility has picked up. And this is the reason why I put it here on this chart to show you the extensions from top to bottom on either end. This is showing you the 123, which is 29.43, 29.83, and 3020, which is the 78, and the 61, a 30.49. The extension to the top from this range here, from the 30.15, is the 56 to the 97, and the higher one would be the 38, 32.22, which let's consider 3.2, and the 61.8, 32.43. So is it possible to go up to this area? Yes. Is it possible to fall back from this area back to the 100% of this move? Yes. We're going to trade what we see, not what we think, and most importantly, pay attention to technicals. I'm going to go right now to from standard, go back to the regular candle trend, and I'm going to go over some of the things we did in the prior month, so that way you can see what the overall market is doing. We're going to put the slash VX here, or the VXO. I use the VXO for one reason, because that one goes to the 1986, because before that, if you use the VIX or you use slash VX, which is the future, they only go till 2009, 2008, because those indicators were not around until that period of time. So instead of the weekly, we're going to go to time frame. We're going to go maximum time frame. Instead of weekly, we're going to go to the monthly. The reason behind this, I wanted to let everybody know, since the 1987, we had that big spike up to this high. Then eventually we fell in this range of the 50 whenever we had major, crisis in bearish markets. And we spiked it in 2000 and 1990, 1991. Then we had a similar situation in 99 and 2000, 2001, the Twin Tower. Then we had the 2003. Then we had the 2008 real estate bubble till April 15th of 2010. We recovered. Then we had the 2012. Then we had the 16, area, which was the Eurozone. We had a minor one in the election time in November. Then we had the Terra 4. Then we had this major spike of the COVID-19 and fear, closing down, shutting down, and the economy is going basically to haywire. As long as we are below this number, $33 in the VIX, this may be choppy for the next couple of months, but let's trade what we see, not what we think. We have recovered quite a bit from the February spike high, which was, until March 23rd, and we came back down to the norms in this range. When you are usually in that $15, $16, $10 area, underneath the 18 usually be neutral, and the economy, is, giving the earnings reports of companies and stuff like that. As far as I don't see the 33 going back above it to the 40 area, we are going to be okay. So that's the VIX. Let's take a look at the bond market slash ZB. And I wanted to look at the which is the 30-year Treasury bonds, because the Federal Reserve Board for the last 90 years, since the 1929, 1936 till year to date, have been supporting the market. And the reason behind them supporting the market, so that way there's a recovery and they are helping the overall economy. It's basically now who's getting hurt because of the COVID-19? Small shops, mom and pop stores. The big corporations are making much more better recovery, better strength, better outlook in the future. And if we notice that 100% retracement, in 2017, if we notice we came back in 2019 down to here because of the tariff war and everything. Now we had this major spike. We're sitting at a double top. They need to keep inflation at a lower rate. This is why the bond price is a little higher. Because if inflation rates picks in a year or so, the bond market will drop down and the spike in interest rates will be higher than the bond price, the par value of it. So that's the bonds. Let's take a look at GC, which is gold. If you notice in GC, in 1980, 1981, we had a similar situation. In 2000, 2001, 2003, we had that. I was trading this area, I wasn't really, a good trader at that time, but it was in the $100 range, $200. Once it got to the $500 range, before the 2008 real estate bubble happened, we was thinking, you know what, gold is overpriced. Since then, gold spiked up because this is not a trading instrument. I rather trade it than hold the position. If you look at inflation and overall what gold has done, I would not hold it as a trading instrument. I look at it as a tool to interactively trade when the fear gauge is there and the non-fear gauge. We had a rounded bottom. We're almost looking at the triple top here. Can gold continue higher on the weekly charts? Of course it does on the monthly chart, but I wanted you to see that because this area here needs to be cleaned up, create some small cup and handle in order to continue higher. And this is why I'm showing gold right here. If I look at it on the weekly spike, you'll see that there is a difference between the top and bottom in spike on gold. This was the rounded bottom. It eventually cleared that 1788. And gold on the weekly chart had an undecided candle in order for it to continue. I'd like to see one more reset in order to continue higher. Let's take a look at oil here. Similar situation. Oil has recovered and filled this gap here on the weekly chart. In order for oil to continue higher, I'd like to consider it creates, a side action a little bit lower, go side action, then continue higher and clear the 61.8 in order to get back to the prior drop that we had here from the 50, 52, 56 area. So I'd like to see, oil come back up, but I need to have a set in it. So let's take a look at now the NQ, NDX on the daily. And if you notice the NASDAQ on the daily chart, plus or minus, why did it do that? Okay. Well, oh, that's 3-year weekly. Yeah, it's a new high, and you can see that there was a spike. I'm going to go to the daily charts. The NASDAQ, if you can see, it had a bottom high, back to the bottom, the channel, up to the high, back to the bottom of the channel, continue and tested that top. If this is going to be considered a reversal bar, I would look all the way to the 18 SMA back to the backside of this channel. Eventually, if it breaks through it, look for the 50 SMA in order for the NASDAQ to continue higher. But trade what you see, not what you think, because this area is going to be very critical in the NASDAQ. That's the NDX. Let's take a look at, that's the leading indicator. Let's take a look at now the DJI, $DJI, that's the Dow Jones Industrial Average. If you notice, it's inside the H pattern from the February till March drop, and we are inside this range. Keep an eye what the technicals, and if we can clear that 200 SMA in it. If not, look for the backside of the channel, the 50 SMA, and eventually the 38.2, which is that H pattern here. That's the Dow. Let's take a look at the RUT. And RU2 is in a similar situation that 1448 or 1450. We have retested it a couple of times. There's a 200 SMA here. Keep an eye on the backside of this channel and the 50. Similar situation to the Dow. Let's look at some of the equities. AAPL. Here's Apple, almost a double top. If this is going to be a reversal, keep an eye on the 18 SMA, and this channel would be dropped. Look for the backside of the breakout. Amazon, annual high as well. Amazon did the similar situation. Here's your Amazon. Looked down, came back up. Looked down, came back halfway. Looked down and continued higher. My line in the sand is about 27.96. Let's call it 2800. Let's take a look at Facebook. Facebook last week had a really nice recovery from the Monday, Tuesday, Wednesday, and this is the Thursday action. Let's take a look at Google. Google did the same similar pattern as Facebook, and here's Google, but it actually looked above that area, which is the 1475, 1472. In order for Google to continue, it needs to clear that area to come back to the 1500 and the backside of the upper channel here. If not, look for the 50 and the 38.2, which is the 50 SMA and the backside of this channel here. Let's Google. Let's take a look at NFLX. Had a new high for the year. Netflix looked above. It's in a linear regression channel on looked up, came back in a little bit. So I could look at Tesla. Tesla had a nice delivery of their electric vehicles, had a nice push high, and we have that professional gap. I marked it here. This is a very important area for Tesla because Tesla has a couple of gaps down here. There's one here, there's two here, there's three here, four, and this is the fifth gap. If this candle gets lost, look for to fill the gap and eventually the prior break at the 1027, 1025 area. If it does not hold this channel, look for the backside of the 965 to 970 in Tesla. Let's take a look at Shopify. Because, you know, people, this is Shopify annual high. PayPal, PYPL. I'm just putting some stuff up there that way you guys can see it. Boeing. I'd like to see, you know, coming back to the 155 area, 145 area to get back in Boeing. American AAL, American Airline, AAL. American, I'm just show ALL, and you've noticed we had that big spike coming back in. If Eurozone is opening and the airlines in the US are, you know, because of the European zone telling us not to travel from US and stuff, eventually things will start to open and people will start moving around the country once that COVID-19 is cleared, and we can rebalance back up. That's American Airlines. Let's take a look at General Motor. And you notice General Motor is, you know, side action. If this is creating a cup and handle, that would be great. Let's take a look at Goldman Sachs. Here's Goldman Sachs. It's in a wedge. You can see that this down channel, you can grab a channel here, so that way you guys can do it on your own at your own time. You take the peaks of each area, connect it to the next peak or the candle prior, and you notice it's in a down channel, and you can connect these two in a symmetrical triangle as well. You can see that it's in a wedge. In order, if it falls back below this wedge and it holds, look for the backside of this wedge, then continue higher. If it breaks through this one, look for the upside. That way you trade, you know, what you see, don't trade what you don't see. And last but not least, what I want to do is go over some of the technicals and the overall markets by looking at historical stuff. What I'd like to do is get that folder. Let me just go look for it. July 4th, there we go. And we're going to start here and we're going to open it. Okay. And what I'd like to do is basically go look at since March 20th when we had the drop in the Dow Jones Industrial losing 900 points. Everybody was panicking. But the scary part when we had that drop and now we are reversing and the VIX is coming back, it was at its peak. So read it slowly. I'm going to just go over these very fast, but what I want you to do is understand that the technicality since that bottom in March 23rd till June 19, 2020, you notice that the S&P, there was a lot of fear gauge and the MACD was continuing higher, and the VIX is below that 33. If we take a look at historical, the 1990s, and today where the VIX is sitting at 33, this is why I'm showing you these things to keep an eye when the volatility is there and there's weakness in the market and there's fear, the MACD drops. the Williams percentage R and the VIX spike up caused a reaction in the market. Let's take a look at it now. We can see since 2008, 2009, similar situation, there was a drop. The VIX was at a peak. Then eventually it took it a while till it came back up, and the VIX is in a similar situation in in 2020, and you notice that the VIX as of April 17th, 2009 had a similar situation at 33. Scenarios here, basically looking at the breadth of the market and the overall moving averages. We had these scenarios happen in 2000, 2001, spikes up, spikes down, 2008, 2009. Then you had it in 2012, 2013. Then we had it in 2016, 2019, and 2020. 2019 was the tariff. 2016 was the Eurozone, Europe, and the British exit. No, this was the election. This was the British Eurozone, and this was the election in 2016. So, and if you noticed over here, I'm going to zoom in a little bit. If you look at historical since 2002, 2009, 2011, 2016, 2019, the overall market has recovered more than 70% rate of return consistently. If we take a medium range is 70, if we take an average range is 91. Is it possible to continue higher? Of course it is, and the market breadth is showing us that. Scenario here, 2008, 2010, similar situation. If I do compare it, and the overall drawdown was about 4.2% in the next 2-3 months, and the overall S&P compounding rate of return from 2008, 2009, that bottom when it reversed in April 17, 2009, that was 869, and we never looked out, and we compounded a rate of return from 2008 till 2000 at 39% compounding rate. Is it possible we can go back to 29, 11, or 28, 50, 28, 25? Of course we can. But remember, trade what you see, not what you think, because you know money managers do want it. They still have fear and they think there's a drawdown of 20% drop. This is showing you from April 17th of 2009 what the overall 5-year compounding rate is. This is from Bloomberg. That was published on June 29, 2020. You can see what Dyer said. You can read it slowly. Looking at the overall market, what the outlook is, and what the fear and non-fear gauge is. You can pause the video while you're doing this. Similar situation, the call-put ratio. This happened, you know, in 2008 till 2009, 2010. We had that 500 year and a half drop down. In April 15th of 2000, we recovered. We have a similar situation as of June 8th, 2020. The call to put ratio, it took us only 83 days to recover. Remember, the plunge protection team, I call them, which is the PPL, the Federal Reserve Board, and Powell, is pumping more money into this market to keep the economy going. And that's what the print shop does for the last 90 years. And if we look at the put to call ratio, this was historical from this time. I'll zoom in so that way you can see it. I was able to pull it out online. You can look at it. Orcom, that was showing the put to call ratio. We have a similar situation here when it happened in 2008 till 2010. We are in a similar situation after 83 years. 83 days, I'm sorry. We have, you know, the fear gauge, you know, the bulls to bear is 48%, while in April of 2010 was 48 more bullish than we are today because of the fear. As of June 8th of 2020, there was a fear gauge showing us that the reaction of people are still bearish because of the outcome in March 17th when everything was dropping. Everybody was buying insurance in the market. If you see here, after the coronavirus in the Eurozone, this is from the Telegram. United Airlines executives say lots of demands for July 4th weekend, no major spike in cancellation. This is going to tell us, hey, people are at the beach. This is a picture on June 25th in Europe, okay? This tells you a lot about our news and our media, what they do to cause people to stay home. I'm not trying to be sarcastic. Okay, this is from LPL. LPL brought out actually MPC. Used to be a broker at National Planning Corp. I'm no longer am. I'm just an individual investor that trades. And this shows that the S&P quarter since 1998 had the best quarter for the year. This tells you a lot about the average rate of return in the next quarter, where it can head to. It shows 9, this shows 13, this shows 15. The median is 9, 15, and 17. Even if we get an 8% rate of return, or even if we get 1 year quarter a bad rate of return overall because of the fear gauge. This is an article that was from Fidelity. You can look it up on Yahoo. This is the author showing you the 1929, 1937. In the last 90 years, the plunge protection team has saved the world. Here's another one. I'm trying not to be sarcastic. In the next, from March till June, can the next 2 quarters be historically the outcome good or bad? Yes. Is there going to be a chop in the market? Yes. Remember, we're going to trade what we see, not what we think. And this is from CNBC News. Okay, let's go one more time. Similar situation. Hedge funds, money's on the sideline instead of being working in the market. Here's scenario 2. One of the money managers being asked, is there a possibility that the 2021 that the S&P can be higher, from now till end of the year? They said yes, but what is the drawdown? They asked him maybe a 20% drop, decline. So remember, money managers are usually funny. They, analysts, they don't read technicality. They don't watch what the market is giving them and what's going on in the overall. They have an opinion about it. Trade what you see on the charts, more importantly than what you think. And that's the most important thing I can tell you, and protect your capital. Look forward to seeing you on Discord or Solstice ATR and over.